Welcome to Value Vest Daily, not financial or tax advice. When physical bottlenecks choke global energy supply chains, the disruption instantly ripples outward, triggering massive worldwide market panic. We are seeing this macro reality play out right now. Following the late February 2026 escalation between the US and Iran, markets have rapidly erased $2 trillion in global market capitalization. This graph maps the carnage. The S&P 500 plummeted to 6,632, the Dow bottomed at 46,558, and the Nasdaq dropped to 22,105. The primary driver is mapped by this contrasting line: Strait of Hormuz disruptions pushing Brent crude upward, surging to $103 per barrel. This dynamic creates a risk-off environment, where capital flees equities for the perceived safety of the US dollar. This flight to safety has triggered 3 straight losing weeks as investors prioritize liquidity over growth. That $103 Brent crude price initiates a strict mechanical chain reaction across the entire economy. Surging energy costs act as an immediate tax on everyday logistics and production. That instantly ignites consumer inflation fears. When inflation metrics rise, the Federal Reserve adjusts its posture. The current data has virtually eliminated the market's expectation for any near-term Federal Reserve rate cuts. The lack of rate cuts means higher borrowing costs, which actively punishes the tech and financial sectors. Conversely, the energy sector has risen 1.88% over the same period, acting as a natural mathematical hedge against the oil spike. To navigate this, analysts use intrinsic value arbitrage. Intrinsic value arbitrage is the quantitative process of separating emotional market selling from actual unchanged corporate fundamentals to find pricing errors. Applying this logic reveals the reality of the situation. The $2 trillion has been temporarily displaced by the shock, creating localized pricing errors across almost every major sector. Professional trading desks often challenge the assumption that a rapid index drop indicates a breakdown of the underlying economy. To prove this, we run historical regression models. A historical regression model analyzes past data variables to measure typical market behaviors during specific recurring events, like the onset of armed conflict. Currently, U.S. stocks are down an average of 4% overall since the war began. That reaction is highly muted compared to past geopolitical crises. This chart models the 1990 Gulf War. You can see the severe 17% initial market drop experienced during the onset of that specific Middle Eastern conflict. Now look at the post-resolution phase. Once the conflict stabilized, the data shows a subsequent 25% market recovery. We see identical behavior in the data from the 2003 Iraq invasion. This secondary line corroborates the exact same pattern: an initial emotional overreaction followed by a steep V-shaped rebound. Historical precedent provides a clear map. Geopolitically induced panic creates temporary valuation anomalies, giving value investors a predictable, measurable window to act. To execute on this window, we have to stop tracking broad market indices and isolate individual corporate fundamentals. Fear-driven liquidity events force large funds to sell assets indiscriminately. This mechanically compresses equity valuations across the board, regardless of a company's actual health. Because of this compression, the S&P's forward price-to-earnings ratio, or PE, is currently dipping below 20 for multiple sectors. The PE ratio is a metric that measures a company's current share price relative to its per-share earnings. Simultaneously, the Fear and Greed Index has hit extreme fear. The Fear and Greed Index is an indicator that measures investor sentiment from 0 to 100, serving as a purely quantitative signal of an oversold market. We filter this oversold market using 2 specific metrics to locate hidden gems: low trailing PE ratios and recession-resistant cash flows. Applying these strict fundamental metrics strips away the noise of the geopolitical shock. It leaves us with a focused list of equities trading at severe discounts to their long-term fair value. This data dashboard highlights the first company passing the value screen, Amazon. The left chart tracks its 12% drop year to date, while the right side displays its low trailing PE of 38.2. Amazon's catalyst remains untouched. Amazon Web Services revenue grew 24% last quarter, and its digital infrastructure is entirely insulated from physical oil supply shocks. Furthermore, e-commerce data shows historical booms during energy crises. Consumers consolidate their travel to save on expensive gas, driving up home delivery metrics. Pivoting the dashboard to United Health Group, or UNH, we see it is down 5% year-to-date, trading at a highly depressed PE of 18.5. Healthcare provides robust defensive mechanics. Medical demand is strictly inelastic to geopolitical wars. Individuals require health services regardless of overseas conflicts. UNH reinforces this inelasticity with a strong Q4 earnings beat and locked-in demographic growth driven by an aging U.S. population. Both Amazon and United Health possess underlying operational strength that completely ignores Middle Eastern shipping disruptions, securing their 25% plus upside potentials. This next dashboard view introduces Qualcomm, currently down 8% year-to-date, with a PE of 22.4. Qualcomm benefits from structural decoupling. Structural decoupling occurs when global demand for a product, in this case AI chips, is entirely detached from the war-impacted physical supply chains moving through the Middle East. Because of this robust independent infrastructure, quantitative analysts project a 30% fair value upside for Qualcomm. Transitioning the data to Comcast, the chart shows a 10% year-to-date drop and a severely depressed PE of exactly 5.76. That specific 5.76 PE makes Comcast the top undervalued asset in the entire S&P 500 based on that exact metric. The core catalyst here is revenue stability. Broadband and cable infrastructure provide highly predictable, sticky cash flows, maintaining steady subscriptions even during severe economic uncertainty. Structurally decoupled tech and essential broadband retain their internal cash-generating power during a crisis. That stability translates market fear into quantifiable upside. Finally, the dashboard pulls up Allstate, down 3% year-to-date with a PE of 5.44. At 5.44, Allstate currently holds the single lowest PE ratio in the entire S&P 500, rendering it heavily overlooked in the broad market sell-off. The insurance sector relies on a counterintuitive mechanic during a macroeconomic inflation crisis. When inflation forces the Federal Reserve to pause rate cuts, it creates a higher-for-longer interest rate environment. This specific environment directly benefits insurance companies. This is driven by insurance float. Float is the massive pool of premium payments an insurance company collects from customers and holds onto, investing it in safe, interest-bearing assets before paying out claims. Higher rates allow insurers to generate higher yields on that retained capital. Allstate weaponizes the exact macroeconomic headwind crushing tech and financial stocks, converting high interest rates into a target upside of 35 to 50%. The current $2 trillion wipeout represents a systemic pricing error driven by oil-related logistics, leaving core corporate earnings power largely intact. This scatterplot maps our findings. It proves we are in a rare, mathematically backed window to acquire these specific high cash flow, low PE equities at a significant discount. Applying this matrix allows us to pivot. We can look at adjacent sectors to see if other industries share these exact same defensive traits. For example, is HIMSS a buy now? Does telemedicine follow the exact same inelastic demand logic as traditional healthcare providers like United Health? Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. Please put in a comment if you want us to deep dive into any specific high-risk reward opportunities. Remember, emotional panic destroys wealth, while cold, actionable quantitative analysis captures it. Stay invested and stay rational.